Benefactor underwriting for this broadcast has been provided by a grant from Republic Bank. The power of red is back. Major underwriting support for this broadcast has been provided by grants from New York Community Bank, M&T Bank, Perfect Building Maintenance, Customers Bank, Collins Building Services, Marks Paneth. Additional underwriting support has been provided by grants from AmTrust Title, Bank of America, Capital One Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC, Handler Real Estate Organization, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Catsimatidis Red Apple Group, New Banks, Meridian Capital Group, Ocean First Bank, RPW Group, TD Bank, the One Stop Property Group, and these friends. Oh, Crystal Apples, you're sitting there, you're placid right now, but I want to know if you're going to be shiny next year? Are you going to be positive? You know, any more Delta variants, other variants? What's going to take place during the year, okay? I can't read minds and I can't read my crystal apples. So today I've brought together, with the help of my executive producer, Adam, three individuals who are active in the real estate market in the metro area to provide their insight on where they see 2022. My guests include Shimon Shakori, who is the founder and the CEO and president of Ariel Property Advisors, Ran Eliasaf, who is the founder and managing member of the Northwind Group, and last but not least, as I said, my executive producer, who's also becoming an executive producer of a movie, okay, Adam Altburn, who is the managing member at the KABR Group. So you've been here, you and Shimon, as we would say, you're the new person. We'll call you the newbie over here, okay? So you've been here for a number of years. Where do you see, hopefully the pandemic is behind us, things are better, Pfizer has a new pill, the other medications and other things are over there. Where do you see yourself and your company, who's in business probably for over 20 years?
Going on 13 years now.
Okay. So where do you see yourself concentrating? Because you have a diverse portfolio, okay? Where do you believe the opportunities are?
So at KABR Group, we have two areas of focus. One is the New York metro market, and the second is Northeast Florida, really from Daytona up through the Panhandle. And I see us continuing to focus on those two markets. When we expand, it tends to be in concentric circles. We generally prefer to be, a mile deep as opposed to a mile wide. And we see opportunities continuing to present in both those geographies.
Which specific asset classes in the metro area do you see as opportunities? Because in the Florida market, looking at your website and reading some of the news reports, your involvement is mostly residential.
True. In the Florida market, it's mostly residential, either value add residential or entitlement and then ground up development of multifamily residential. We see that continuing. I would equate Florida and the Southeast to a growth stock, and I would equate the Northeast, where we are also doing a lot. We currently just put a building under contract in Bayonne, New Jersey. We're seeing flex industrial B quality, so kind of under the radar of the Class A, high quality, publicly traded guys, a little bit too big for maybe the smaller guys, or too much work in the flex industrial area up here and the multifamily area up here. And I would call the New York metro market right now more of a value stock. It needs a story, but if you're willing to roll up your sleeves and get some dirt under your fingernails, I think there is really a lot of opportunity here.
So how do we ask the former naval captain, I believe, in the IDF of Israel, where do you see the opportunities? Because you've gone from ownership in many cases to more on the debt business. And as I was saying before, lots of people went into the debt business. So you have to find the niche in the debt business. Where do you see the...
I mean, we've stopped buying in Manhattan or New York around 2017. After that year, it was tough for us to see value. We try to focus on risk-adjusted returns, and the risk seemed high and the return seemed low, to put it in a simplistic manner. So we've started lending at the end of 2017, where it made more sense on a risk-return basis. During the pandemic, we raised a fund and we've fully deployed it since then, mostly in condo inventory loans and some bridge acquisition.
as opposed to construction loans?
As opposed to construction, we've decided we don't need to take execution risk. Will they build it? How long it will take them to build? All the complexities around doing ground-up development in the city, and focus more on just the market risk. What price will they sell it at? How long it will take them to sell the inventory? And since we really believe in New York and Manhattan long term, we felt that 2020 looked like a very good timing to lend on condos, and we were proved to be correct
Right.
in hindsight, as the market really opened up towards the end of 2020, early 21, and we've seen sale velocities increase and prices actually go up.
Timing is everything in the condo business, okay? There was too much inventory before, but you know what? The trough has come down a little bit. People bought when in certain markets where they could get some good deals. People talk about Coney Island in the residential basis as a rental. You don't see too much for sale condominium being built in Coney Island. Then you take a situation which happened to be in the Wall Street Journal today, where they were talking about Flushing. Flushing has been on a boom for years, but you have to know who you're dealing with in Flushing. It's in addition to the market, you have to know who the sponsor. Okay, knowing the sponsor is difficult. Speaking of that, are we seeing foreign investors come here?
Yes, we do. And that's something that we've started seeing in the beginning of the year. We're seeing them coming in, buying parts of land, buying it with sponsors. We're seeing them coming into the multifamily asset class, the simpler one, not necessarily affordable housing, mostly on a free market basis. We don't see them as much as we did in the last turnarounds, but they're just trickling in. I think next year is going to be a much bigger year for foreign investors looking into New York City.
One of the insights that came through on the show about the condo market over here, the Chinese investors are back in the $1 to $3 million condo market. Okay, that's what they're looking for. Maybe to pied-à-terre, maybe to rent it. Okay, but that's what they like. And that's been fortunate because of the Solo project on First Avenue, which was very slow, but that niche that they found, I think it's a niche question of what's the right niche. You talk about Bayonne, okay, there are other cities in New Jersey that have, Newark, Harrison, and Bayonne are the three highlight cities because they're not far from the city over there. Where do you believe, why Bayonne as opposed to Newark and as opposed to Harrison, let's say?
Bayonne, we have a deep knowledge of Jersey City. Bayonne is the next stop on the light rail, enjoys some of the same features, and in a lot of ways it's a more affordable alternative to some of the Jersey City high-rises. It's safe, it's accessible, it has a good diversity of food and restaurants, and it's highly commutable both to New York and to other parts of New Jersey. Harrison and Newark also enjoy some of those same attributes. Indeed, Harrison has done very well, and Newark has certain recent highlights. Newark always feels like it's about to turn the corner. Hopefully, it gets around the corner one of these times.
It's like getting the rookies. Some of the rookies will win, and some of them don't really. It takes a little longer. So he's talking about New Jersey. You're talking a little bit New York City. There are a lot of condo developments up in the Westchester area. And the fact that they're commutable to the city makes something. Would you do a condo inventory loan out of New York City?
So our current focus is New York City, including all the boroughs, Jersey City included, and 20% of our fund is other major gateway cities. Our focus was, when we analyzed, we said, we're not going to do ultra luxury high end because it's much more volatile, especially when market shifts, as we've seen. So we actually focus on what you mentioned is units that are trading in between 1 million to 3 million, what we call the middle market.
Right, which is, there's easier accessibility to sell them.
It's easier, it's a wider crowd, especially with the financing options that are available now and cheap mortgages. And it's hasn't been hit as much, even through COVID. You've seen units of $1.5 million condo in the Upper West Side still traded, even in the height of COVID. In less velocity, but not dead. Yes. Where $10 million condos were dead for about 4 to 6 months, just didn't move any inventory.
Yes, and there's just a lack of inventory for that product type. I think that also allows for land prices in Manhattan, which were around $400 a buildable on average last year, to grow next year. I mean, as the confidence builds in the condo market, both developers and lenders will get more comfortable with developing condos moving forward, and I see it next year.
You know, you're in the investment sales, but you're also in the financing and the capital business. Have you seen lenders go after construction loans today of new condominiums?
So yes, but it's just started recently. Our guys are working on 1 or 2 projects like that. I believe that next year you'll see a lot more of that. I think you got to see the absorption in the market, which we're just starting to see from a residential perspective. From a lending perspective, there's a tremendous amount of liquidity. I mean, you can talk to someone like Ron, who sees it every single day. We were on a few deals together with our originators, and the amount of competition that you have today for bridge and where that trades, which is, you know, in the single-digit sphere, is just amazing.
And I think another interesting point we're seeing now, we also lent on a couple of multifamily properties that were in completion mode, not complete yet, no TCO, so kind of pre-TCO completion loan. We underwrote, you know, it was probably 90 unit on First Avenue. We underwrote rents at a certain point. Once they got the TCO and leased up, we were very surprised to see no more concessions, and rents are actually up, I would say almost 20% above our underwriting. And you're probably seeing it as well. The multifamily market is back in a big way.
Right.
Huge.
The rent growth has been really strong, both in the New York metro market and in the Southeast. And you have right now a really interesting convergence of a lot of inflationary pressures that are taking hold, including on rents. But you also have historically low rates that are existing right now. So the convergence of those two things are really making for a very opportunistic time if you can find well-priced multifamily assets to be a buyer.
See, but I believe for the last couple of years, you know, speaking to some investment salespeople and other people, a lot of the well-established people who own significant holdings in multifamily have looked other places. Okay, you're Florida, but there are many people who have gone to Alabama, they've gone to different places in a similar manner that you've been in the healthcare business in a variety of things. At 305 West End Avenue, you've lent. Talk to me about your thoughts about healthcare. People getting aging older, they're living longer, and so on.
We started to look at senior housing and healthcare around 2016. Just looking at demographic trends in the U.S. I mean, they refer to it as the silver tsunami, right? So you're going to have 25% of the population above 65 years old in the next 10 years. You have all the baby boomers coming in the next 7 to 8 years. We started in New York. We expanded to the Midwest, where we own a significant portfolio. And the last 2 years, we started lending. Same thing that happened to us in New York, where we were on the equity side. At a certain point, the risk-adjusted returns stopped making sense. We started lending. A little bit of that is happening in senior housing. It's not that necessarily if you build it, they will come in any location. In our opinion, New York City is being overbuilt right now in seniors housing. When we bought our property in 2016, there were 3 others assisted living properties. There's probably 9 others now built or being built, asking big numbers. So we actually decided to exit New York City in senior housing and focus more on Midwest, where there's different trends in the population. You know, a lot of New York City people, when they get to a certain age, might decide to, you know, move to Florida or other locations. In certain cities in the Midwest.
I was thinking of Herzliya.
Yeah, that too. That is a great weather. In certain places in the Midwest, people tend to age in place. They're connected to the community, to the churches, to the, you know, families.
Are you seeing people interested in senior housing?
Yeah, I mean, we do a lot more affordable housing when it comes to that. So Ron is focusing mostly, I think, on so to speak, fair markets housing and licensing. But in the affordable world, we are seeing a lot of need for affordable senior housing, like Sarah and so on. And we actually are seeing some developments that are coming out of the ground in certain areas, specifically in the Bronx. And one of the interesting parts today in the Bronx specifically is figuring out what to do with land. And in some cases, it lends itself to senior housing programs.
Right, but those
Affordable.
Yes,
With
affordable.
incentives.
Yes,
Wait,
with incentives and
affordable with
everything.
incentives with nonprofits involved.
Correct.
Right.
Okay, so it's a combination. Unless you
Correct.
have all those elements, you're not going to be able to do
Correct.
it over there.
Which is not less important than for-profit.
No,
We're
no.
doing both.
You have 2 hotels, I believe, in Texas, or
Yeah, we have a hotel in Texas, a hotel in Jersey City.
right. Let's
and-
talk about the hotel. I mean, the Canopy in Jersey
Yep.
City.
So our hotel in Jersey City, the Canopy in Jersey City, is doing well relative to where we've been within the pandemic. You know, we own it with great partners and strong hands. So clearly, the occupancy and the rate were disappointing for a stretch, but we feel very good about the growth that we're projecting and that we're seeing. You know, it's a top of market product, so we're confident that as rooms come back into the market,
but
we're
there's
going
been a lack of hospitality in Jersey City. So
Correct.
there was a dire need, really, for more hotels in Jersey.
Yeah, no, it's great to be in a market where there's
Even
not
though
enough
you might think I'm
inventory.
his broker over here to finance it with you, but I'm not.
No, that the fact that there's not enough inventory of really new, good, high-quality product in Jersey City has worked very well for us, and will continue to work well for us. So we like it. We like that we own it. I would own more product like this in Jersey City if you could do it, but it's not easy to do because you have to find the land, get it approved, build it, and that's a real arduous process, but we're very happy that we own this product.
So here's a question. I'm listening to the conversation, and my mind is saying, we're not talking about the office market. Now, I know you made a investment with the GFP people, wonderful, the Goral people,
Great.
on that, you know, but I haven't heard really any bullish comments from any of you with regard to the office market. And it's a segment of different worlds. There's the A and the B, and then there's the C and the D.
I think
we've-
there's the A and
office-
the A,
Yeah.
and then everything else.
So we've done 40 Exchange, which was a 300,000 square foot office building, and we bought it and sold it. And 7 Hanover Square, which is a 1 million square foot office building that we're selling now. And we had great success in office, but it's definitely an asset class that needs more focus and has challenges ahead of it in the next 3 years at least.
Yeah, I agree with Ron. I mean, we've owned as much as 4+ million square feet of office, maybe closer to 5. We're down to about 1.5 million square feet of office. We've done well in the asset class, and we would look to buy more of it, but office is an opportunistic and basis-driven and time-driven transaction. And if all of those pieces of the puzzle are not in place, unless you just say, hey, I'm going to own some bricks in a great location in New York with very little leverage, it'll be okay eventually there too, but otherwise it's difficult.
I agree with both of you, but the A-class are weathering the storm and doing very well.
But the properties which I just said, the C and D, which Shimon called the A and A, nobody wants the C and D. And they can't, many years ago, there was a 421G program in Lower Manhattan. And the program gave incentives to landlords of 30 years of taxes. If you don't give incentives, there's no way you can do it. It's not going to, we do need residential, but you can't convert this without.
Can't convert
You
all
also
of them.
compete for talent today, and that's part of what's happening. So when you compete for talent and you're a bigger company, one of the things you want to do is have an office that's amenitized and attracts that talent and retains that talent. That's part of what I'm hearing.
And if you look at what's happening in New York, this super high quality Class A product is being very well leased because
Right.
people who are rolling are saying, okay, what do I have to give my employees to incentivize them to be in the office? How much am I going to pay for this versus what are they charging for the rung below? And there's been a clear flight to best in class quality.
I had Tommy Craig of Hines on the show recently, and he basically said, we're renting space from $50 a foot to $300 a foot. It's that wide of a disparity over there in the market. And another person recently said to me, you make more money renting an office building in Long Island from industrial point of view than you make it as leasing an office building in Long Island. You have one office building in Long Island right now.
We have office in Long Island and we have industrial in Long Island. One is a gross rent, one is a net rent. Thankfully, we're doing very well with both assets. But the reason is because in the case of the office, it is A plus location.
Right. It's a true location.
I'll make another distinction. With the A-class buildings, you have longer-term leases. The Bs, the Cs, the Ds, usually an office lease would be 5 years. The amount of TI that you have to put in when your leases roll every 5 years, you have to buy the building almost all over
Right.
again every
Right.
7 years in those shorter duration.
Correct.
And the mindset that was, in the last 20 years, Class B office building, multiple tenants, 5-year leases, roll it over, is not adapting well.
Also, the undercurrent of New York office that is often not being spoken of is a lot of these assets are performing well now because these leases remain in place. But as these leases start to roll, everyone's kind of burying their head in the sand, but when these leases start to roll, there are that flight to quality, that intense renegotiation, those big TI dollars, those are going to be part of the conversation. And landlords that have an elevated basis or a shorter runway to debt maturity are going to have some, serious and maybe uncomfortable conversations.
And I'll say one more thing. The future of New York City in office is tech companies, large and small. Most of them are looking for A-class product to put their tenants in, or their talents in. The city needs to adapt to that type of office, and it's not going to be the banks as the largest tenants. It's not going to be WeWorks as the largest tenants. It's going to be technology companies. That's the driving force of the city, and they're not discovering the city now because they fell in love with the city. It's because there's talented people here, better connectivity with
Education.
education, and it's at a better cost than it is in Silicon Valley.
Right, and in a similar manner, the life science business.
Yeah.
Same thing.
Okay? And I know you were involved with one of the life science business.
We helped raise money for the Tasty building at the time, which is suited for life sciences. And, at the time, which was 2-3 years ago, it was one of the only buildings that's coming up to be a life sciences building. There are a few more now. It's definitely hot industry.
Life science needs a
But
cluster. You
yes.
need to create a cluster,
Right.
like,
So the
Kendall,
nice-
like Kendall Square.
Right.
The nice
And the
thing is-
city, there's
See,
locations.
Right, they're pods, but as medical will be that like a technology, but you need to get a critical mass to start driving the talent and the creation of space where they can all use it.
You know, for years, First Avenue, York Avenue was called the Deadpan Alley, okay? You know, you had NYU, then you went up to New York Cornell, you went to Rockefeller University, Sloan Kettering, you know, and Hospital for Special Surgery. In that market, you can see life science. Alexandria is over there. Deerfield is not exactly there. They're 345 Park Avenue South. It takes a number of years to be a successful life science company, and not everybody wants to live with an incubator company.
So, Michael, what you and Ron and Shimon have successfully pointed out are the things that ultimately, right, technology, life sciences, healthcare, these are the things that are going to keep New York relevant as we go into the future, no doubt. But that transition, which we're seeing right now, is taking place right now, takes time, right? The metamorphosis is occurring now. And when times of change are not always the most comfortable times.
It's a question of how long it's going to take. It's going to
2
take.
years.
Right, okay? I think you're at a 2 to 3 year situation.
Yep.
But I'd like to thank my friends Shimon, Ron, and Adam, the producer, okay? Thank you for being here. And hopefully, apples, be shiny, only shiny. May take you 2 years, but be shiny. Okay, thanks again.
Thank you.
See you next
Thank you
week.
for having
Thank
us.
you. Thank you.